Hello, everyone. This is Tim Picciott, and it is February 27th, 2019. And today we're going to talk about the markets absolutely exploding. And I know that people that have been following me for a while, they're probably thinking, well, hey, you were very negative on the market. Now we've seen the market increase quite a bit. And really, what's your take on that? And so what I want to do is respond to, because I'm sure I'm going to have clients who are listening to this. I'm going to have friends and family members and potential clients who are watching this. And so what I want to do is kind of give a little bit of an accounting of what has happened from essentially it was October 3rd is when everything kicked off. I made my infamous video on October 2nd talking about different black swans that were out there in the economy, and ended up releasing that video on October 4th. I made it October 2nd, got all the proof for that, and I went over the whole litany of reasons. Well, most of those reasons still exist today from a fundamental level, but what happened was on October 3rd, the Federal Reserve President Jerome Powell came out and said that basically everything was amazing and that the natural rate of inflation, that we were very far away from that number, and signaled that the rate increases would be going up and up and up at a gradual pace. Then what ended up happening is, the stock market didn't like that. Stock market started going down. They met again, or the next comments were made in November, and things were still on pace. We're still rocking and rolling. We're still having the increases go up at a steady rate. Then, around Christmas time, they had the acquiesce, and they had all sorts of things like the plunge protection team, which I'm not going to get into today, was enacted. You had all sorts of other shenanigans really being pulled. And then the Federal Reserve then came out and said, I believe this is the beginning of January, actually we are very, very close to the natural rate of inflation. And we're actually probably not, and we're even looking at, taking our balance sheet that we were decreasing $50 billion a month. We're thinking about actually maybe even pausing that. There's also been hints at actually having rate cuts, and actually the market is starting to price that into effect. So you're seeing this gigantic U-turn where before Powell even came out and made those comments, I came out the day before and listed a whole litany of reasons. And if the government wanted to save some money, what they could do is just go back through my podcast the past 2 years and maybe hire me, or just listen to my podcast for free, and they could fire all of their economists, and they can fire basically everyone on staff, because I don't know how little old me, who's, just one of the things I'm doing is coming up together with this data, is able to kind of piece this together while they have no idea what is absolutely going on. Now, one guy that does know quite a bit about what going on is Jeffrey Gundlach. For the clients who are listening to this, last year, he was actually probably about the last 2 years, one of your biggest positions was one of his funds. I don't want to mention that fund because then I've got to get into all sorts of regulatory stuff. And this would be a good time to make a disclaimer that unless I'm your advisor, I'm not your advisor. This is all for informational purposes only. No one has a crystal ball of how this is going to play out, and I'm sure I'll have some sort of other disclaimer in here as well. However, let's go now to a clip of Jeffrey Gundlach and see what he has to say about the market. Again, he ran the largest, so out of all of the major large bond funds last year, his fund had the best return, which still, was not a great return from an overall number standpoint, but at least he didn't lose money. So here we go with Jeffrey Gundlach, and I rolled this for 2 minutes.
Really railing against how much money we spend on old people in the United States government system, as opposed to how much we spend on young people. And in that article, the ratio was 7 to 1. How much of the budget goes to paying for things for people over 65 compared to paying for things for people under 21. I can't remember if it's 21 or 25, whatever, but young people. And if you're investing in dying people and not investing in the future, you don't have a very bright future. And so millennials are starting to understand that the baby boomers have all the wealth, and millennials don't really, they can't afford a house, they've got student loan debt.
Right.
And they're starting to believe, I think, finally, that they kind of got screwed by the system.
When you see a number like 22 trillion for the nation's debt, are we past the point of no return? What does the day of reckoning look like?
Yeah, I think we are really at that tipping point. So since we're not going to do anything about it in the next couple of years, almost certainly, I think once we get to 2020, 2021, I think you will be past the point of no return. And so you're just going to have to deal with it. And one of the problems is that we have 22 trillion in debt, and it's growing very rapidly. But we also have $123 trillion in unfunded liabilities. The state and local pension systems in the United States, on average, are 50% underfunded. So if you take a look at Illinois, there's no chance that Illinois can honor its pension obligations to its public unions. It cannot do it. So what's the solution? Well, the solution is you have to cut benefits. When you have $123 trillion of unfunded liabilities, you have to decommit. You can't fund them. To fund them, it would be amazing. I mean, we have to go to, if we funded $123 trillion of future liabilities, that's 6 times GDP. If we did that over a 60-year period, we would have to take 10% of our GDP every year and put them aside into funding these liabilities. So we'd go from an economy which is 6% in deficit to, we'd have to go to one that's 10% in surplus. So it would be 16% swing from where we are today. So we cannot fund these liabilities. So what has to happen is we have to raise the age of entitlement eligibility, and we're going to have to cut people out even though we told them that they were paying into the system as sort of an insurance program for social.
So there's certainly a lot to chew on with everything that Jeffrey was saying, but this is something where, everyone who voted for Trump pretty much, has had their head down in the sand completely. It's well known that I voted for Trump, but, to see, this whole situation where we're going to basically temporarily explode the deficit to, help the stock market, and we're going to give the richest companies in the world tax breaks so that way they can buy back their own stock, which then also games the stock market and makes things appear temporarily better than they really are, for this temporary success of, oh, look at me, look how great of a job I'm doing. And to that credit, I would say, well, anybody can cut taxes and increase spending. And it's the whole increase of spending that a lot of people aren't really even aware that's actually going on. So with what Jeffrey Gundlach was talking about is, with all these unfunded liabilities, that the debt is much, much larger than the $22 trillion that is actually talked about, and there's actually no way that we can pay these off. He's known as the bond king. He ran the fund that was doing better than almost any other fund out there. And so I'm going to kind of shift gears a little bit now and talk about the markets exploding higher, and then really kind of get into why they've exploded higher. So as of yesterday, so this would be the 26th of, this is as of the 25th of February, we see that the markets have gone up. The S&P 500, that is, the index has gone up 11.5% year to date, which is obviously a very, very good start to the year. And so you might be thinking, okay, well, surely the S&P 500 earnings, those must have gotten better. Oh no, this is from a Zero Hedge article. You've seen that we've had the worst 3-month drop in 4 years when it comes to forward expectations. Right around the time the market started rocketing higher was the exact same time that the S&P earnings started going lower, which is sort of, absolutely crazy. And all this has to do with the very first presentation I made when Trump came into office. He was I started making it actually before he was technically even in office. So started making this in January 2017. It was called The Trump Effect and Why Good News is Bad News. And the premise was that Trump would do things that would, certainly relative to Obama and relative to Hillary, would juice the economy. Then that would then lead to a lot of optimism. Then that would then lead to this whole hope effect of what was going on, which would then ultimately lead to the Federal Reserve not having an excuse to not raise rates anymore. And then that would be the bad news. So I call it why good news would be bad news. Now it is just the opposite, where the bad news that is coming in is now giving the Federal Reserve the excuse to not raise rates anymore, to potentially even cut rates, and to potentially stop their balance sheet unwind. And so it was the bad news that is now leading to the good news. And before, it was the good news that was leading to the bad news, because we live in a simulation of the Twilight Zone, is what it appears. Then you'd have to take a look at, okay, well, the S&P 500 earnings. And this is the source from this is FactSet. Surely those have gotten better. Nope. Year to date, the S&P 500 earnings down 2.7%. So sort of crazy world that we live in. Then you've got the macro surprise index for the United States. So this is things like the unemployment rate and manufacturing index and really big picture type data. And we've seen basically as of mid-February, that absolutely is cratering down. I think it was like the largest cratering since 2011. I just clipped this out, so I don't have the exact data right in front of me. Then you take a look at the U6 unemployment rate. This is a much broader measure of unemployment, One of the places that you can get this at is shadowstats.com, where there's a guy, I believe his name is John Williams. He goes through, and actually, you know what? This is the inflation data, so you guys bear with me. I'm going to head over to the unemployment rate. And so U3 is the number that's always reported. That's gamed and rigged 7 ways to Sunday. Let's say you used to be making $100,000 a year, and as an engineer, and now you're making $50,000 a year, and you're working 3 jobs to do it, and you're an Uber driver, and you're a bartender, and you're a waiter, and you're working 3 jobs. Well, now it counts as 3 jobs to the economy, even though you're making half as much money. And so technically, from the economic standpoint and through the unemployment rate standpoint, you actually look better than now with 3 jobs making half as much than the 1 job making twice as much. And that's only just one of the ways that they go and rig this number. Again, you can go to howitsrigged.com. I don't know why I said it again, because it's the first time I've actually mentioned it. Howitsrigged.com. I wrote a book on this. It's only 18 pages long. I could have made it 100 or 200 if I wanted to, but why make it that long when you don't have to? And you're seeing the U6 number is a slightly broader number that counts basically more things. And actually, it is a much more accurate number, and I'm kind of eyeballing this right now, but it's getting around like 7%, maybe even 8%, just from a pure eyeball standpoint. So yeah, we're seeing that number go up as well, which would indicate that things are not going better with the economy. So as we continue on with the presentation, another thing people must be asking themselves is, well, surely with all of the stock market going up, well, the GDP numbers, well, those must still be at around 5% from what they were last year. Well, you would also be wrong, because the Atlanta Fed is now showing that the fourth quarter 2018 GDP is actually going to plummet all the way down to 1.8%. And so if you take a look at the last year's GDP data, where the first quarter was 2.2, the second quarter was 4.2, the third quarter was 3.5, the fourth quarter was 1.8. You add them all together and divide by 4, you get 2.9%. So this whole, economic miracle, they said it couldn't be done, they said it couldn't be at 3%. Everyone was claiming that it was going to be over 5%. I said there wasn't a chance in hell, and got absolutely ridiculed. And I told a lot of Trump supporters, hey, what you shouldn't do right now is you should not hang your hats on the stock market. You should not hang your hats on the unemployment numbers. You can go back to prior podcasts where I have the proof of, I believe it was 26 times candidate Trump said that the unemployment numbers were the fakest, most phony, baloney numbers around, that they shouldn't be trusted. And now that they are working in his favor, he now wants to use those. And I think that it's a very dangerous game. I think it's a disingenuous game. I've taken a lot of flack for saying this. And you know what? A lot of the flack that I've taken, if people would have put their own partisanship and, team-like mentality aside and listen to me, if they truly were Trump supporters, they would be helping him out by pointing out that he shouldn't be doing this, and because ultimately this is going to come back to bite them in the butt. Now we're looking at is previous quarters of GDP, and what you see here on there's a 5.1, followed up by a 4.9, and you also see before that there was a 4.7. Well, those were Obama's GDP numbers. Again, I was pointing this out at the time when people said we had an economic miracle, we're at 4.2%, and they said it couldn't be done. Well, Obama did it. And again, everyone knows that I'm not an Obama fan. I originally wrote How It's Rigged to dispel a lot of the crap that he was doing. The whole reason he was at 5.1, and I can't remember all the details off the top of my head, but it had something to do with they gamed the quarter before that and made it bad. So you do see on the chart it shows a -1 before that, and they pushed a whole bunch of spending when I think we were starting to invade Libya when we weren't invading it as a kinetic peace action. They did all this crap to basically game those numbers and make them look a lot better than they really were. That's we're not trying to look at the past. Now we're looking forward. So if you're gonna hang your hat on I've got the best quarter of GDP ever, and they said it couldn't be done. Well, Obama did do it technically. So again, I'm not a huge Obama fan. Everyone knows that. I actually do like a lot of the stuff that Trump is doing, but he is very disingenuous on a lot of it. And so this leads to we're having the best 9-week streak in 24 years, and it's off the tail end of all this bad news that I'm talking about. And so another thing that's going on is that, surely if things are going as good as we've been told, that the Fed can keep reducing the balance sheet. And what we've seen is that it looks like that the Fed Reserve at some point is going to actually announce that they're going to probably stop that balance sheet program as well. And we've got an analyst from Bleakley Advisory Group, and this was part of the Zero Hedge article, where it says, bottom line, while the Fed, I believe, clearly had room for the current pause because of the economic slowdown going overseas, And it's funny how they list, overseas. They don't, of course, ever blame anything on that could be, starting or emanating from America. It should also be clear to everyone that they are mostly beholden to asset prices, both the stock market and credit spreads, with that driving the policy. And that's absolutely correct, that they care about the stock market. Otherwise, they would have why would they have done the U-turn? I was the one that was right all along, saying that they basically couldn't raise these rates. Yeah, they could, but they're only raising them so that way they can drop them again, and that things weren't going as well. And I've got it all on record. I've came out with podcasts the last 2 years. I had Facebook posts going back, the past, basically since Facebook was created, pointing out all this stuff. Now we're looking at is meeting minutes continued. Among the considerations were the recent softness in inflation, the government shutdown, the path of fiscal policy, and officials also weighed the impact that Fed policy tightening moves, as well as the ongoing trade negotiations between the U.S. and China would have in the economy. So these are part of the excuses of why they didn't raise the rates. And now what I probably should have done now at this point, played the Jeffrey Gundlach interview, but they say, this fiscal path. I mean, what fiscal path? We would have to have, like Jeffrey was talking about, a 16 point swing in the other direction, and then use 10% of GDP to then pay things off over a 60-year time period. And again, I would go, and I keep saying again, I shouldn't say that, but you can go to the video I did on December 23rd, talking about how the Federal Reserve works. I really made that video about 3 years ago, but then I re-aired it. So I really highly recommend that, because there is no way to pay off a debt-based monetary system. And if you guys want even more hilarity that's going to ensue, on March 1st, the debt ceiling comes back into play. And so, yes, the debt ceiling has been suspended. I think it's been suspended for about a year or so. I don't know the exact date of when it was suspended, but that will be coming back into play. Was that Friday? Or maybe it already has come into play by the time you've actually listened to this. And then you take a look at, okay, well, the debt limit may not be increased until October, Chuck Grassley says. So what they do in order to, so we're going to hit the debt limit, or the debt limit is going to be reimposed from the date that we're at when March 1st hits, and then it's going to be frozen. And then what they do is they have to clear up room inside of there called headroom. And how they are able to fund this is they have a whole set of extraordinary measures that what I'll do is I'll link an article I wrote on this in 2017, which I then sourced the treasury.gov article from where I pulled this data from. So I didn't just, pull it out of my butt. I actually, this is coming from treasury.gov website. And so how they clear up headroom is, think about it if you had a credit card where you had, a $20,000 max and you had a balance of $19,950. You need to create, another $1,000 of room in there so you can spend it. So you can spend it. How would you create extra room in there? Well, if you're the government, what you do is they have something called the G Fund. That's where government employees are putting money into their version of like a money market fund. And the long story short is they take that fund and rate it, and then they use it for themselves, and then they create another $225 billion. So they steal, $250 billion from the government employees is probably the biggest thing that they do. Then they also take the Postal Service Retirement Health Fund, the Civil Service Retirement Health Fund. The Civil Service one, they create $6.9 billion of headroom per month. The Postal Service, they create $400 million per month. And going off of, if this were to last for 3 months, that'd be almost $22 billion of headroom that they would clear up, meaning 22. So if the debt limit was 22 trillion, now you just less 22 billion off of that, then the other 225 billion that we had mentioned before. These are from 2017 numbers. I didn't go back and actually, calculate out. But I mean, it's the same crap that we're going to pull this time too. So I don't need to get the exact numbers because they will be very close to these. And what they did in 2017 was, when they did this, they said that that we'd create $70 billion by suspending the CSRDF investments. That's the civil service one. The $13 billion that was going to be made to that fund. We're going to take that money as well. And all the crap that they do basically clears up $83 billion in headroom from stealing from various retirement accounts, not including the G Fund. Then they have an exchange stabilization fund. They take $22 billion from that, and then they take $3 billion to $13 billion of new treasury issuances that should be going to state and local governments. They don't do that, and that saves them $3 to $13 billion per month. And that is essentially how you manufacture a crisis. So what they do is they wait to the exact point where there's no other. So let's say they're going to deal with this in October, when the absolute. So it's like if you were all your credit card bills are at the absolute max, and you're saying, okay, what I can do is I can put, a lien in my house, I can put a lien in my car, and I can sell off all these items, and then basically if I don't deal with the actual underlying problem, I will I can make it 6 months, and then I'm going to wait till, 5 months and 3.5 weeks into it to then start saying, we've got to do this or else we can't fund the pensions and we can't fund the Social Security and we've got to do this, and if you don't sign off on this, and this is unconscionable, and how could you think of the children when really it's the older people, as we mentioned before, who are getting the benefits 7-1. And then if you know what the destination is, you know what the journey is, and so you've got this whole Green New Deal where AOC, Alexandria Ocasio-Cortez, is proposing, and a lot of people actually don't even know this. She was proposing, and this is just absolutely crazy. I'm not looking at the notes here, but within 12 years, stop all air travel, because we're going to have a rail system that's going to go all throughout America, and that is actually going to cross the oceans, so that way we don't even need airplanes anymore. We're going to ban all air travel. We're going to ban cows from farting and getting off basically meat as much as possible, because actually all the methane from their gas actually creates more global warming than pretty much anything else. Then we're going to remake every federal, state, local government employee or building in America over the next 12 years. So, just think of all the actual carbon footprint that would be required to redo every building in America. You'd have to move mountains, and they would all have to be energy efficient. So, aka solar power. You get solar power, you use silver in there, all sorts of lithium parts, all sorts of rare earth minerals that you literally need to move mountains in order to create. So, just absolutely ridiculous. And so with all this, the rates cannot go higher from all the debt that we have. They need to keep these schemes where they, keep printing money to buy back our own debt, to make sure that the rates go down. If you don't know what debt-based monetary system is, YouTube, Hidden Secrets of Money Part 4, Mike Maloney. I'd also watch the video I did on the 23rd of December that breaks it down as well. And ultimately, will the market go up? Will the market go down from here? Nobody knows. But the strategy that we have right now, since we are in this crazy time period, that I do not think this strategy will work forever. This is not a strategy you want to have forever. But what we're doing right now is we're using a small amount of people's portfolio, investing in the put options. So if the market ends up plummeting, then that's going to greatly limit the damage. And if the market, soars because we have some, $93 trillion plan when, a socialist gets elected in 2020, then, or who knows, maybe a socialist getting elected in 2020 will make the market go down. Then they print a whole bunch of money and then the market goes up. Nobody knows the trajectory of how this is going to happen. And so if you're close to retirement, you need to be concerned about sequence of return risk. If you've got friends who are close to retirement or in retirement, they need to be concerned about this, because right now everyone has their head in the sand. This is if you watch the State of the Union, it's an economic miracle that we can't believe this has been seen. I also recommend going back and watching the full Jeffrey Gundlach interview, or at least the first 20 minutes of it. Very smart guy. And I was going to put up a mashup of things that he said versus things that I said, because he came out with a video in December, and I've not really been paying too much attention to him the past 2 years. But if you go back to his video, it was like everything I've been saying the past 2 years, without almost word for word in many cases. So it's just sort of crazy. But ultimately, the money does have to go somewhere. And so an example I like to use is if you were a German in 1900, hopefully you weren't Jewish, but if you were a German in 1900, if you had Mercedes-Benz stock versus holding money in Goldmark, which was their currency at the time, the Goldmark collapsed into, I believe it was the Renmark, then I believe it was the Reichsmark, then the Deutschmark, and now it's the Euro. So if you're holding on to Goldmarks, boom, you're wiped out. Holding on to Renmark, boom, you're wiped out. Holding on to Reichsmark, boom, you're wiped out. But if you're holding on to a stock, now it's getting repriced in different assets, and maybe you still lost money, maybe you still lost purchasing power, but you had a real asset that was there. So I think that is the case to have some stock. But I think you also need to have some guaranteed income coming in from some sort of stream. That's a whole nother subject on that. And then, with longevity risk, that is the risk of living too long. And so for a lot of my clients, we've got you taken care of on all these different issues. If you're not my client, I'd head over to thelibertyadvisor.com. You guys can schedule with me over there. I don't want to make this too much of a commercial, but, you've got another opportunity. The Dow is back at 26,000. This is, a blessing in disguise. If you guys didn't, act the first time, again, I'm talking to people that are not my clients right now, then, you're getting a redo. You're getting a mulligan. How often do you get a chance to do a redo?
And the strategy that we have, it was, still going strong when the market was going up, and it was very, very strong when the market was going down. And so that's sort of, have your cake and eat it too, especially if you've got money sitting in bonds and you're 64 years old. So many things you could be doing to get, more income coming in, get more stability, have more potential even price appreciation on the upside, depending on what strategy we end up employing. But, we're going to sort of cut it from today. I was on the radio a little bit before this, kind of giving the same spiel. So my voice is a little bit shot. I've always had a weak voice. I don't know why that is, or I don't know how to make it stronger, but maybe it's just because I don't shut up long enough in between to ever fully recover from this. But head over to thelibertyadvisor.com. Make sure you spread the links far and wide. We do a lot of live streams now to DLive, so it's dlive.tv/thelibertyadvisor. Same thing with Twitch. It's at The Liberty Advisor as well. I don't really encourage people to watch YouTube because of all the shadow banning. Same thing with Facebook. I don't really encourage that either because of the shadow banning on a few other platforms as well. But anyways, check me out on those. Make sure you share the links. Again, you can also go to libertyadvisor.com, upper right-hand corner, podcast, and see where we're being displayed. It might say show by now. I'm not sure if it's been changed, but we're on all the big platforms like Google, iTunes, Player.fm, Stitcher, maybe one or two others, Podbean. So make sure you go and rate that 5 stars. Maybe give a nice little overview as well. You're probably the first one to do it. So someday when I'm big, a few years from now, you'll be like, I was the first person to rate him. Or hopefully by the time you read this, maybe 5 or 10 people will have rated me. I doubt it. So anyways, if you guys do that, I'd appreciate it. And talk to you guys later. Take care. Bye.
Thank you for listening to the show. One of the ways you can help support the show is by seeing if it makes sense to invest with myself. I'm a certified financial planner with Innovative Advisory Group, LLC. Innovative specializes in self-directed IRAs where you can invest into virtually anything, including virtual assets and cryptocurrencies inside your retirement accounts. And get this, you can actually hold on to the private key. And that's something that nobody else is doing, at least with the help of an advisor. We also run protective growth portfolios where you invest a small amount of your portfolio into put options, and that basically helps protect the rest of the portfolio. Not very many people are familiar with put options, but a lot of people are familiar with homeowners insurance, and it works in a very similar fashion. So essentially what you're doing is using a very, very small percentage of the value of the home to protect the rest of the home. And if the house doesn't burn down or there isn't a major catastrophe, then you're basically out on the cost of the insurance. Flip side, on if your house ends up burning down, well, then you build your house back. And that's really the same thing that's going on here. So if the market ends up tanking, and we know the most that you can possibly lose on your investment, and honestly, if the market were to go down 60, 70%, and you're only down single digits potentially, then that's an amazing buying opportunity. Lord Nathan Rothschild said it best, that the best time to invest is when there's blood in the streets. But if your money goes down with everybody else's, then you're not able to take advantage of the next crisis. And also, if you're just camping out in cash or in bonds, making next to nothing, you could be going broke safely for a very long time. And then you've got to know when to time the market. And that's something that basically nobody can do. Now, on the flip side, if I'm wrong in all this and the market keeps going higher, or the Federal Reserve comes out or the European Central Bank comes out and says, hey, we're going to print a whole bunch more money, and the market goes to infinity, well, then you'll go up to infinity minus the cost of that put option. So I think that this is a great strategy that you definitely want to learn more about. I mean, just given the craziness that's going on right now, if you're heavy into cash right now, heavy into bonds, or even heavy into stocks, especially if you're close to actually needing those funds for retirement, or just needing those funds in general, maybe for a big project, or maybe you work on a crypto and you raised a whole bunch of money, that this is something that we can help protect yourself and protect your loved ones. And there's nothing you have to lose by scheduling a free consultation with us. And actually, there's a chance you could lose a lot by not talking with us in general. If you go and click on our website in the upper right hand corner, there's a Work with Tim button up there. You can see all of our plans, ways we work with our clients. Pricing can all be found there. And given that I'm sort of out there on a lot of different political issues, I know that I'm not going to be for everybody. That's sort of my way of qualifying you, not the other way around. But I'm fine. I'm not trying to have all 6 billion people out there like me. And I'm here to really, at the end of the day, to tell the truth and to make money, not necessarily make friends. So head over to thelibertyadvisor.com and let's see what we can do for you. Thank you.